Great. Okay, so thank you everyone for tuning in today and watching live. The session will be recorded as well for anyone who wants to refer back to it later or even share it with their colleagues. And there is an opportunity to ask questions as well. In fact, I welcome those throughout. So if you could please use the chat function rather than the Q&A function, and I can then just keep an eye on the chat, and I might pick some questions up as we go. Any others I'll try and get back to at the end of the webinar. Today is our first webinar in a quarterly series that we're rolling out specifically for solicitors. So we hope that our series of webinars will be helpful to you all. They might be helpful for you personally and professionally, as well as for your clients too. They'll usually be focused on financial matters. And today's update is focusing on property tax. And it's predominantly focused on residential property for no reason other than the fact that that's how most of the changes seem to have been focused over the last 12 months, and there hasn't been a great deal going on in terms of commercial property changes. So starting off with stamp duty land tax, where they're definitely keeping us on their toes at the moment with the different changes coming in. And I'm sure many of you are just trying to catch a breather at the moment from having a very, very busy 3 to 6 months. Some of you might even say it's been a year or so where you've felt run off your feet from when the temporary thresholds were introduced. So what best place to start than the temporary thresholds? I'm sure many of you are very keen to forget that there was ever a time when the threshold was temporarily increased to £500,000. The SDLT saving for purchases in that period was up to £15,000, as we all know. So it was a fantastic tax saving for them, and definitely explains the pressure we would have all come under, solicitors especially, to try and get those completions over the line. The temporary threshold has been reduced now to £250,000, and that will stay in place until 30th of September 2021. The saving is worth nowhere near as much, obviously, as it was previously. It's only worth £2,500, but I'm sure we'll still have plenty of clients who want to make the most of that opportunity. And again, we might start feeling a bit of pressure in the next couple of months leading up to the end of September. And now that the temporary threshold is below the limit for first-time buyers relief, we see a reintroduction of that relief again, and I'll cover that off just very briefly in the next slide. Now, I would have had conversations with a number of people who I know on the webinar today about what could have been done in the run-up to the 30th of June 2021, for a transaction where completion wasn't quite ready to happen by then, but everything else was nearly there. Was there any way to accelerate the SDLT point? The reason I'm covering this off now is I think it's helpful to recap on the planning that some people would have put in place. And it could also be helpful in September as well if there are other transactions in a similar position. Although with the reduced SDLT saving, it might not quite be worth as much fiddling around with things to try and get that tax saving, bearing in mind that a purchaser of a property having to pay slightly more in the way of legal and professional fees in order to do that, and against a £2,500 SDLT saving, the benefit might end up being quite negligible by the time they've taken into account those costs. But SDLT is always assessed at the effective date. As we know, that's usually completion, but there is an opportunity to bring that effective date and therefore the SDLT assessment date forward, where substantial performance takes place. In order for this to happen, there does need to be a contract which is in place between the seller and the purchaser, and that contract must then be substantially performed, which means that either the purchaser must take possession of the property, and that's far more than just having the keys to the property. It's also having control over the property as well. So it's not enough for the purchaser just to have access to the property. They need to be able to redecorate if that's what they wanted to do, or rip the kitchen out if that's what they chose to do. So possession could be a little bit tricky, but if you had a contract which was already exchanged, it has on a few occasions been possible to negotiate that. The other way of substantially performing a contract early ahead of completion is for the purchaser to pay a significant amount of the purchase price. And that's not actually defined in tax legislation, but it's generally accepted to be 90% of the purchase price. And that's also the approach that's been adopted by HMRC. Of course, paying 90% of the purchase price is just not going to be possible where there's a mortgage lender involved. So that opportunity has only really worked for cash buyers. So hopefully that's a helpful recap. Could be helpful in September, subject to how much a client pushes and you know how big that rush is really leading up to 30th of September. So just recapping briefly then on relief for first-time buyers. We haven't had to think about this at all the while that the threshold was at £500,000, but it's just worthwhile a short reminder. So this relief is available to individuals only who are buying their first home to live in, and the purchase price of that home is no more than £500,000. And it's only available where all of the purchasers have never owned a major interest in residential property anywhere else in the world before. And where these conditions are met and this relief is available, then there's no SDLT on the first £300,000, and then it's the usual 5% up to £500,000, and all of the usual rates apply beyond that. So this is an SDLT saving of £2,500 for first-time buyers up until 30th of September, and then it reverts to the usual SDLT saving of £5,000 thereafter. Just a quick word of caution, again as a reminder, this relief isn't available where the 3% surcharge applies, and it's also not available where the transaction is linked with any other transactions. And that could be the case if the transaction is linked with another at the time of completion, or whether there are subsequent later transactions which are linked with it, then the first time buyer's relief can be withdrawn. The only exception to that quirk around linked transactions is if the purchaser is buying some land adjacent to the property, i.e., garden or grounds of the property, and they're purchasing that in a linked transaction rather than a single transaction with the main dwelling. And that itself wouldn't disqualify them from claiming first-time buyer's relief. So just to give an example of when the 3% surcharge might apply to someone who is otherwise a first-time buyer, if a flat is purchased for a married couple to live in, but in this example, the husband owns an investment property, if the wife is then the sole purchaser of the new flat, although objectively she alone might tick all of the boxes for first-time buyer's relief, the fact that her spouse already owns another dwelling and they're not replacing their main residence in this example, it means that the 3% surcharge would apply because the two of them are married. So in this instance, the wife won't benefit from first-time buyer's relief, even if she otherwise meets the conditions. So coming on to multiple dwellings relief and mixed-use transactions. Personally, I think this is a really fascinating part of stamp duty land tax, and we've seen the goalposts shift a lot over the last few years, partly as a result of case law, partly as a result of approach, and of course the 3% surcharge really changed the dynamic of some of this. So there was a recent change in November last year, which impacts mixed-use transactions with more than one dwelling. I know that a number of people watching would have received a copy of our info sheet that we put together, and that was rolled out around Christmas time, just to explain what the change was, what it meant moving forward, and how it could impact recent transactions. And it also had a number of case studies on it just to illustrate the potential value of this change. If there's anybody watching today who, or at a later date, who hasn't received a copy of that flyer and they'd like to have access to one, please just drop us an email. I'll be more than happy to give anyone a copy. It's also available on our website, so you can have a look there. And so previously, before this change last year, where there was a mixed-use transaction, meaning that it had residential and non-residential elements to it, the default position, as is today, is that the non-residential rates of SDLT would apply. Now, where the non-residential rates of SDLT apply, we don't have to worry about the application of the 3% surcharge. That only applies to residential rates of SDLT. So often what we found is that people purchasing mixed-use transactions would have accepted the default position and paid non-residential rates of SDLT. But there was an opportunity if there were multiple dwellings, and I'll use the example of 3 or 4 flats above a commercial shop. There was an opportunity for multiple dwellings relief to be claimed in respect of those flats, but it often just worked out that by the time you built the 3% surcharge in for those flats, it wasn't cost efficient to do that. So most people wouldn't have claimed the relief, although the facts of every case are different, and there are some people where they would have still had a tax advantage for claiming multiple dwellings relief. The U-turn from HMRC is that the 3% surcharge no longer applies where that residential property is purchased as part of a mixed-use transaction. So where a claim for multiple dwellings relief might not have been cost-effective in the past, if we now ignore the 3% surcharge, there are some really big savings to be had. So obviously this affects any transactions moving forward, but it can also mean that there are lots of clients out there who are in a position where they can claim a repayment, where they might not have claimed multiple dwellings relief before, but they're still within that 12-month window from their purchase to be able to make that claim and get that repayment from HMRC. We've had a lot of success for clients in getting those repayments back from HMRC since they announced in November last year. So that's been a really interesting development, and there are also some good cases going on at the moment. We seem to have a fairly steady stream of stamp duty land tax cases which is being heard in the courts at the moment. Just a few from recent months, and we have Mullane, where the taxpayer had purchased the main dwelling and an annex, and they had claimed multiple dwellings relief for their transaction on the basis that the annex was also a dwelling in its own right. And this went to the courts, who ruled in favour of HMRC and said that the annex had inadequate kitchen facilities to be considered as a dwelling in its own right. And this was a really interesting case. I think it really highlights how careful we need to be when we are looking at annexes and trying to decide whether a claim for multiple dwellings relief is justified or not. The kitchen facilities, it did have some, but the judge was just of the opinion that they weren't good enough. And I think it's all relative to, you know, our own backgrounds and experiences about what kind of kitchen we would be happy with. I'm sure that when I was a teenager, I probably rented studio flats which had worse kitchen facilities than this particular annex. It did have worktops and a kitchen sink, and it had an electric cooker which was installed. So it would be quite interesting to see whether the taxpayer tries to appeal that decision. In some ways I hope that they do, because it's, you know, just how can we hinge a whole case just based on one person's opinion of what adequate kitchen facilities are? It doesn't feel like it's quite fair to the taxpayer. Another good case, which just underlines some principles that I think we're all familiar with already anyway, is in the Kating case, where the taxpayer purchased a flat and also the right to access the communal gardens for the people who lived in that development. And the taxpayer amended the SDLT return to say that actually it was a mixed-use transaction because the right to access the gardens was a non-residential matter, and therefore he wanted to pay the non-residential rates of SDLT which were available for mixed-use transactions. Unsurprisingly, the courts didn't agree with his decision, and they insisted that the residential rates of SDLT were due, on the basis that actually the right to access communal gardens was, interestingly, an exempt interest, but also it would have been part of the grounds of the dwelling that he had purchased anyway. And another good case was Brand Bros, and it just underlines another SDLT principle that we're familiar with. This is where the company purchased a property with a garage, and on the effective date when they completed, the company granted a lease over the garage for commercial use for a number of years. And they assessed the whole transaction as being mixed use on the basis that the garage that they'd granted a lease over was now non-residential. And that was not upheld on the basis that the purchaser had done that on the effective date, but immediately after completion. And this just underlines the principle that when we're looking at how land and property is used, we have to look at the recent history in the hands of the seller. And anything that the purchaser might do immediately to try and influence that is really disregarded. It's not very relevant. The recent history is far, far more important when trying to determine these things rather than looking at future use. So another good change that we've had recently, which will keep us all on our toes over the coming years, I'm sure, is this 2% surcharge for non-resident buyers. And so this extra 2% SDLT is going to be payable by all non-resident purchasers of UK residential property from 1st April onwards. It does have quite a few similarities to how the 3% surcharge operates, but there are some subtle differences, and I'd really recommend that if ever you're coming across, or as and when you're coming across a transaction where this 2% surcharge applies, you go back to the rules, examine them again with a fresh pair of eyes, and determine whether or not the transaction is caught when you've got these overseas purchases. And the key points to note, a bit like the 3% higher rate, it's got a £40,000 threshold. So any UK property purchased below that threshold, this 2% surcharge won't apply. And there are exemptions for certain types of residential property. The example that's made it onto the slide is student accommodation, but that is purpose-built student accommodation that's exempt from this surcharge, in addition to care homes and other similar properties. Again, as with the 3% surcharge, if there's one purchaser who attracts this 2% surcharge, it applies to the whole transaction, the whole purchase price. There's no apportionment. But there is an exemption for spouses and civil partners. So where you have two spouses and one of them is treated as UK resident and the other is treated as not UK resident, the non-resident spouse will be treated as though they are UK resident for this purpose. So providing at least one of the spouses are UK resident, they won't have to pay the 2% surcharge. And again, going back to some basic principles, this 2% surcharge, it is a residential rate of SDLT. So it doesn't apply to mixed use transactions where the default position will be to pay non-residential rates, and it definitely won't apply to any commercial non-residential transactions either. Now, unlike the update that I've just given for multiple dwellings relief and the 3% surcharge, this 2% surcharge will kick in for a mixed-use transaction where multiple dwellings relief is claimed. So it's the total opposite of the application of the 3% surcharge and a mixed-use transaction. I think it's just worth mentioning there are some transitional rules in place. So where contracts were exchanged before 11th of March 2021, when it later completes, it won't attract the 2% surcharge on the basis that the contract was in place before that date. And so it's possible that we'll all come across some transactions in the coming months, especially if there are off-plan purchases. And they'll be completing, but we won't have to worry about the 2% surcharge, providing the contract predates 11th of March. Now, the residence tests are really interesting, and yeah, they'll cause a lot of headaches, I'm sure. For individuals, they've tried to make it quite straightforward, and they've departed from the residency rules that we have in place for other taxes to try and make it a little simpler. when, you know, really it's you guys as conveyancers that are going to be assessing some of this. So if an individual has been in the UK for 183 out of the 365 days leading up to completion, they will be treated as a UK resident, which means that they don't have to pay the 2% surcharge. If someone doesn't meet that test, they will be treated as not UK resident and the 2% surcharge is going to apply, but they can then later claim a repayment if they do then meet that test, and they've got broadly 2 years to be able to get that repayment. The residency of companies is a lot more complicated, so it follows the normal corporation tax rules, which are complex, but there is an override where the company is controlled, meaning at least 50% of its shares are held or influenced by non-resident shareholders. So yeah, it'll be interesting to see, you know, how this all unfolds. At present, my understanding is that the SDLT return hasn't been adapted in any way to take into account this new surcharge. And I think the expectation is that HMRC will make some changes in due course. For example, we might have an extra code for box 1. For the time being, we're just meant to use code 04, which is the one we would choose where the 3% surcharge applies. And so HMRC haven't really got any way of capturing this information from an SDLT return about whether or not we are applying this 2% surcharge. We have had a couple of SDLT questions. I'm just mindful of time. I've got about 5 minutes left. I'll just quickly rattle through a capital gains tax update and then I'll move back onto the SDLT questions that have come in. I have had a question about whether someone can ask a question relating to commercial property SDLT. Yes, you absolutely can. As I said at the beginning, if you were here in the first few minutes, the only reason I haven't covered off SDLT relating to commercial properties because most of the changes recently have been in connection with residential property. Again, had some interesting changes recently, which are all centred around the reporting and payment timeframes for capital gains tax. I'm well aware that most solicitors won't provide capital gains tax advice to their clients. However, as the people on the ground who are dealing with the transactions and seeing them, and you know, sometimes you're the first people to know about them before someone thinks to tell or speak to an accountant or a tax advisor. I think it adds a lot of value where you can point out to your clients that actually they may have some capital gains tax issues and they should explore that and seek advice early on in the process. So very broadly, where UK residential property is sold, it needs a return to be submitted to HMRC within 30 days of completion, and the payment of capital gains tax should be made at the same time. For people who are not resident in the UK, they have this requirement not only for UK residential property, but for all UK land and property. So it could equally apply to a shop or a piece of their land, which is being sold by a non-UK resident. And where these returns are filed late, there are late filing penalties. So if it misses that 30-day deadline, it's £100. And then there are further penalties after 6 months and 12 months, which can be tax geared and they can rack up quite quickly. And there's also late payment interest if that payment comes in late. We have got issues with underpayments. An underpayment, if it's a large underpayment, it can mean that further penalties are charged if the capital gains tax return which was filed was not dealt with reasonable care. So if the taxpayer has deliberately or even just negligently from not paying enough attention, if they have put the wrong figures on their CGT return and they've got a large capital gains tax underpayment, they can get a penalty for that, as well as being charged interest on the underpayment. But we also have some issues around overpayments at the moment where HMRC systems are not joined up at all. And if someone overpays capital gains tax and they're later completing their usual self-assessment tax return, which is due by 31st of January, if they've overpaid on their 30-day CGT return, they can't actually offset that against the rest of their tax due. by 31st of January, they have to go through a very, very cumbersome process with HMRC to try and amend manually the CGT return that they've submitted. There's no easy way to do that. You can't do it online just by filing another form. So underpayments and overpayments can both cause issues. I'd really recommend that anybody selling property thinks about this well in advance, ideally when they first kick off the process, and they can get their ducks in a row so that within that 30-day window after, they are able to meet their requirements and be compliant. Crucially, there are some exemptions from this 30-day returns. The first is where there's a disposal with no tax liability. So if the gain is within the annual exemption, or it's a transfer to a spouse which is exempt, or main residence relief applies because the client has always lived in the property, and there'll be no need to prepare. Also, property developers are exempt from this if they're going to be paying income tax on their disposal. UK resident companies don't have anything to worry about here either, anything to file, and any non-residential property sold by UK residents is outside the scope, and in fact actually overseas properties generally. A bit of duplication there on the slide. So that was a quick CGT update. I think just having an understanding of some of those issues can be really helpful when speaking to a client who's selling a property, and just making them aware it needs a little bit of attention. So that was the end of the slides. I can see that a few questions have come in. I'm just going to try and go through some of them now. Okay, so the first one which has come in asks, what is the position if a first-time buyer is buying two properties, both completing on the same day? And that's a good question. It's been a while since I've had to consider that. My expectation is that because it's the end of the effective date, I think it's a similar test to the 3% surcharge, meaning that if at the end of the effective date they own more than one property, they may well not be eligible to first-time buyers relief. But again, it's such a point of detail. It's something I would need to go away and check the tax legislation to conclude on. And then a question about if a company purchaser has agreed to purchase two adjacent properties, but through two different estate agents and from two unconnected sellers, would this be a connected transaction? Okay, so for transactions to be linked together, which means they are assessed as though it's one transaction, and SDLT is dealt with on the global consideration for all of the transactions, we need three conditions to be met. And the first is that the purchaser is the same, or that they're connected. And in this example, we've got one company purchaser, so we know that that condition is met. And the second is that the sellers are the same or connected. So in this example, if they are two unconnected sellers, that second condition wouldn't be met, so they wouldn't be linked transactions, so they can both be dealt with completely separately, which is good in a way, because it means that they'll get two bites at the 0% thresholds and the 2% thresholds and so on. But it also means that they won't have any opportunity to claim multiple dwellings relief, which might have put the company in a slightly better position, potentially, depending on the facts of the case. And the third condition, just for completeness, that needs to be met for linked transactions will be that the transactions are part of a series of transactions, and they're part of kind of one overall deal or arrangement or series. So again, if they've been negotiated completely differently and one transaction hasn't affected another at all in any way, then again they can't be linked transactions. So the commercial property question which has come in is, if a commercial property is purchased in a limited company and then want to sell to DB SaaS company, will it have to pay SDLT? I'm going to assume that this is a question about moving property from a company to a pension scheme being a SaaS. If I've misunderstood that, please get in touch with me separately and I'll be happy to discuss it with you. But where property moves from a company to a pension scheme, the pension scheme always has to pay market value Yeah, that is correct. Great. The pension scheme always has to pay market value for that. And the pension scheme will also be chargeable to SDLT on that market value consideration as well. So yes, a transaction of that nature would absolutely be chargeable to SDLT. Okay, that's all of the questions which have come in. So if no one else has any others, then I think we can probably wrap the webinar up. I hope it's been really helpful to everyone just to get a quick update, and it's been delightful for me to be able to speak quite freely with other professionals and conveyancers who already understand the foundations of SDLT, and yeah, it makes my job much easier. So it's been great, and I hope everyone's enjoyed it. As I said at the beginning, please feel free to pass a link to the recording on to any of your colleagues if you think it will be helpful to them. And as ever, if I can be of any further use or assistance, or you've got any other SDLT cases that you want to chat through, you're more than welcome to get in touch with me. It'd be great to hear from any of you. Right, okay, thank you very much.